I'm Keith McCullough, and welcome to another Real Conversation. It's my pleasure to have long-standing, really, I wouldn't call it guest. It's more of a pro-to-pro conversation that I have the privilege of having with someone who I was complimenting the other day on the Macro Show, Daniel, which is you yourself. You know, he's live in the flesh, which is somebody who's not just like a strategist and economist, which I rant about all the time, but somebody who actually ran money and has practical solutions for a lot of the things that we talk about. So I do think that's always been a big reason why you and I have gotten along. We've both done a lot of jobs, and it's nice to have you back. Well, first of all, it's been a little while.
Thank you so much, Keith. Always a pleasure. It's been a while, but it's always great to have a conversation with you. It's always a fantastic and riveting moment to discuss all the things that are happening. Thank you so much.
Yeah, I assume you're in your home right now. That library of yours, that big beautiful library.
Yeah, the big beautiful office in the third floor of my apartment. So yes, this is the place where I write my books and my articles and everything.
Yeah, he's, of course, you got the Canadian talking with the Spaniard here. So I don't think you need many different languages, by the way, to see a 3-year, a 1-year chart of the U.S. dollar in particular, the breakout, the inverse correlation that is gold related to it, the renewed breakout in Bitcoin. There's a whole bunch that's already been happening. And when something is happening in macro, people want to know a little bit more about the why. So maybe start with that. Obviously, we have the big headline on what we're going to talk about today. But for me, I mean, it's like it's either the beginning of a bottoming process for the U.S. dollar, or it's just going to keep going down, down, and down. I don't know what the answer is or has to be. It doesn't have to be anything.
I think that a number of things have been happening, and the most important of them all is that global developed economy currencies have stopped being global reserve assets. That is the most important one. The most important thing is that the central banks of countries all over the world have stopped purchasing treasuries, sovereign bonds from developed economies as the reserve asset that provides stability, that provides a little bit of return, that provides a little bit of strength to their own currencies in the balance sheet of their central banks, and they have moved on to purchase gold. This is the most important thing that has happened in the fiat world in the last couple of years in particular, but it's an ongoing trend that started a few years prior. So I think that this is what is really the most important element. When you look at the graph of the US dollar relative to the euro, the DXY index, which is fundamentally the US dollar relative to the yen and the euro, what you end up seeing basically is that the US dollar is moving in these sort of very typical trends of like ladder, no? Of like a ladder with a bit of strength and weakness, moving in a very obvious trend, which is that the dollar sort of strengthens throughout time against the euro and the yen, but has these periods like the one that we're living today in which it weakens and it looks like there's a very significant change of trend. However, when you look at the dollar against gold, the yen against gold, and the euro against gold, that is when you really see what is going on, which is that the loss of purchasing power of developed economies, currencies, is being demolished completely. Now, and I think that is the element that we need to take into account. Will we see the DXY, the dollar, start to strengthen in the next months? Two things. Neither the Bank of Japan nor the European Central Bank are going to defend their currencies above a certain level. The moment that the euro dollar reaches 120, the European Central Bank is going to, it's going to look like Kiss's firehouse. It's going to be alarm bells all over the place, in which the European Central Bank is going to try to do anything and everything to weaken the currency. And the euro dollar exchange rate is pretty evident in its trend. It's gone from 1.6 euros to the dollar to 1.17. No, the fact that it's bouncing is something that is in my view, nothing that is going to change that long-term trend. But the yen is also an important one. The yen has been at lows, at 40-year lows relative to the US dollar until very, very recently, and it's basically on a short-term bounce. But I come back to the point. It's neither the US dollar, nor the euro, nor the yen, or the British pound. It's developed economies, currencies, losing the purchasing power and being offset in the balance sheet of global central banks with gold.
Yeah, that's it's a critical distinction, and I want to get into both topics because again, gold as a reserve is different than a lot of interplay in the U.S. dollar relative to the major currency pairs. I think that I don't want to put it in the parking lot. I mean, for me to be long the euro like I am and have been, has never happened before, and B, if it did happen, I wasn't making money on it like I have been lately. So, that or the pound. I mean, I could be long one or the other. I mean, actually, let's just do that first. I mean, what is it about this moment for the U.S. dollar? Again, you can go with whatever you want. I'd say credibility and the potential move at the Fed is got something to do with it. There's a lot going on there that is, dare I say, a little different this time?
Things that are a little bit different is obviously that the Federal Reserve's policy is completely the opposite of the policy of the Bank of England and the European Central Bank. And this is a first. That's why you rightly called this change. No, this is a first. We have never seen developed economies, central banks moving in opposite directions. We have seen them maybe with small delays, but always sort of coordinated. No, I think that is critical. Why? Because obviously markets follow the money. No, so if markets see a hugely dovish ECB and a relatively hawkish, let's not call this hawkish, but it's relatively hawkish Federal Reserve. No. Then that market suddenly goes from hugely underweight European equities, hugely underweight European bonds, and starts to go, I wouldn't say overweight because it's not been there yet, but has started to go at least in line or equal weighted in portfolios. And that is obviously huge selling of US dollars, big purchasing of euros, no, and the same with pounds. Interestingly, considering all of the concerns about the US dollar that I read about, if you look at the nominal trade-weighted US dollar index, that has actually moved quite a bit less than the DXY. And I think that is an important factor in terms of not making the mistake of thinking that this move that is basically money managers going from underweight euro to overweight euro, or to at least equal weight euro, with a change in trend in terms of the United States. In fact, what we have seen, interestingly enough, is a de-euroization of the world. The euro has lost places in terms of the utilization of the currency in SWIFT payments, etc. Interestingly enough, the euro has gone from being the number 2 asset in global central banks to being the third, being overtaken by gold. No, so it's not a de-dollarization. It's simply, I think, the manifestation of a level of confidence from market participants that when you called rightly the strengthening of the euro relative to the US dollar, there was a lot of doubt in the market about whether the Fed was actually going to be significantly opposite, or at least very, very different in terms of policy compared to the European Central Bank. But now you have the evidence, no? And I think that obviously generates also a fear of missing out relative to euro assets.
Yeah, it's interesting that you also have a divergence. Those divergences are critical. Policy divergences, we pay a lot of attention to those. Economic quad divergences, that would be our own proprietary calculation on that. But guys, if you can show slide 34, I mean, for Germany to have a run of 3 straight quad 2s, that would on its own be bullish euro, right? I mean,
Yeah.
in rate of change terms, whereas the U.S. Is coming out of a quad four between February and April, trying to climb out of it, but ending up with stagflation. That's what going from quad four to quad three would mean. So I find that to be interesting as well. But back to we have policy divergence, we have quad divergence, but we also have that political divergence that's new. Like the ECB isn't threatening to fire Lagarde. I mean,
No.
Trump is saying whoever wants this job, like he only would. David Malpass, put up your hand. Say that you'll cut by 100 basis points. If I appoint you head of the Fed, then have at it. That's a major credibility problem. That's at least being priced in some way, shape, or form into the weak dollar. Is it not?
Probably, absolutely. The concern about interference of the U.S. government on Federal Reserve matters. That is obviously something that is up for debate. Let's start from the fact that the independence of the Federal Reserve has been more than questioned. Let's not forget that the Federal Reserve decided to cut rates by 50 basis points in the middle of an election when there was no macro and certainly no employment reasons or inflation reasons to make that massive reduction in rates, no? And the Fed has gone from being hugely dovish with worse macroeconomic and certainly inflationary figures than today in 2024. Furthermore, I always say this to my students. In 2019, the Fed cut rates three times, citing global uncertainty as the reason. Okay? Seems that Mr. Powell has found a lot of certainty these days, my friend. So it's a little bit, we can joke about it, but I think it's, you are right to point out that it is not a joke that we have gone from a period, we've had these discussions a few times, in which there was concern about the lack of independence of central banks, to there is certainty about the lack of independence of certain.
That's really good. Yeah, I mean, it's a thing. It's like, okay, we have this entire academia, the entirety of the establishment. We all know that you know that you're full of shit. Right? You either don't know what the future is going to look like, or you pretend to, or both. And you are politicized. I mean, so we all don't trust each other. So the trade is we do trust gold because there's no central banker for that. And we might try this Bitcoin thing. Right? Yeah. I know you've started to write about that. Do you think that that's a fair characterization, where we're finally there? Like, you and I have only been talking about this for bloody well 15, 18 years.
Absolutely it is. Absolutely it is. Because let's go back to the politics. No, the reason why markets are not concerned about Miss Lagarde being fired is because Miss Lagarde's independence is inexistent. Obviously. So Ms. Lagarde is cutting rates like there's no tomorrow because she has to disguise the massive fiscal imbalances of the French budget, and has to disguise this enormity of spending from the German government, spending in defense. The European Union has just announced they're going to spend 800 billion in defense, and nobody seems to ask, how are you going to fund it? Nobody, no? So obviously you don't have that question with the ECB, you don't have that question with the Bank of Japan, you certainly don't have that question with the Bank of England, but the only central bank in which there was at least a debate that the members were actually a little bit more independent was the Federal Reserve, and that obviously fell down in 2024. But this is what's important, is that what you just outlined, is that gold and Bitcoin are functioning right now the way in which central banks or independent central banks should work in a monetary system, in an independent monetary system. The central bank should be the one that puts the brakes and limits the obsession of governments of increasing their fiscal imbalances and passing the burden to consumers. So they are the ones that should be having as a clear policy inflation and limiting the voracity of governments with fiscal policy. However, when central banks instead, what they do is that they tweak with interest rates and call that hawkish, okay? Which hurts families and businesses, because obviously governments, to be fairly honest, I've seen no government anywhere in the world worried about rising bond yields. None. They may say that they do, but they're not. Why? Because they're going to pass you the bill in higher taxes. So so central banks in the last 5 years have only used one tool, which is interest rates. Because in terms of liquidity, there has been no hawkishness whatsoever, and there's been absolutely zero level of control of the excesses of governments in terms of expenditure through the balance sheet. Look at where the balance sheet is with the Federal Reserve. Look where the balance sheet is with the European Central Bank. The Federal Reserve's balance sheet should have come down in 2024 by 3 trillion. It barely reduced by a trillion. No? So I think all those things are important. Why? Because the reason why gold and Bitcoin are right now functioning as what central banks should do, which is to be a limit or at least a break on the excess of fiscal policies, is because right now governments are worried about what I said prior. The fact that their bonds are not being purchased by other central banks globally in their balance sheet. They worry about that, and they do a lot. And it's also important because in some countries, be it El Salvador, etc., but there are a few that are starting to accept Bitcoin as a means of payment, an official mean of payment. So all those things are important. But I also think that it's very, very important to understand that the missed opportunity of 2021 to 2024, in which central banks have prioritized liquidity and have prioritized disguising fiscal imbalances against their objective of reducing inflation, what ended up doing was the following, was that on the way in with monetary policy, easing destroyed the position of the middle class with inflationism, and on the way out, it's destroying the middle class with elevated rates, you see? So that is the problem of, let's say, not paying attention to what a central bank should do. A central bank, if we think about we don't need to go that far. If we think about 1999, 2001, a central bank would have never maintained the monster easing and negative real rates in 2021 in the middle of a reopening of an economy and with a government that decided to increase 2 trillion the expenditures over the already allegedly extraordinary expenditures of COVID.
Yeah, it's let's get into this to the fiscal side here momentarily, but the markets figured this out, and I mean, for a long time, especially if you're like, and I'm definitely not one of these, when you call yourself a Bitcoin enthusiast or whatever, one way only type, that's not something that they actually got for a long time. Yeah. What they got in being long Bitcoin was cyclicality. Every time a quad 4 hit, Bitcoin crashed or blew up, then you get to buy the dip, you go on. It's very high beta. You know, and now we're finally starting to see the volatility of Bitcoin burn off. It's definitely not gold, and gold's not Bitcoin, but you are finally starting to see that credibility trade that is not new. Guys, pop up the inverse correlation math that's been trending. I mean, on gold, to your point, Daniel, it's been very obvious going back, not like 90 days ago. So where we have this here, we have the US dollar against everything else. But 90 days ago, it really became more clear for Bitcoin. right?
Yeah.
For gold, it was clear 120 days ago. It was clear 180 days ago. So again, now Bitcoin has joined it, and to me, that's like a 6-month window that is a material change, because Bitcoin, again, Bitcoin's not gold. They didn't trade together between February and April. Now they're starting to. Okay.
Yeah.
So I'm not saying they have to. You're saying there's been a behavioral shift on what do I trust? Well, I don't trust a bunch of these crusty old central bankers that all go to the same schools that are completely full of shit. I trust the market. And I trust those prices. And that's, like, to me, hopefully people have a pretty good macro awareness that this has been happening. But hope, as I like to say, is not a risk management process. And the reality is, if they don't subscribe to me ranting every day, they probably don't see this correlation table. But every day that I wake up, it matters every bit as much as anything else. I mean, the other big thing that's happening there, of course, is that like they would if you're expecting the Fed to eventually turn tail dovish with a new head of the Fed and cut rates. The stock market says I'll go vertical on that, right? Dollar down, assets up. The poor get poorer, the rich get richer. That trade, that's on.
That is on.
I'm not laughing about the poor, by the way. That was poorly.
No. Obviously, we're not. Actually, if anybody has been saying over and over and over again that this insane monetary policy that we have been living since 2008 is detrimental to the middle class and to the poor, as you or I or many others of our esteemed colleagues. But I think it's very important to understand a few things about Bitcoin. What was the main reason why a lot of people were negative about Bitcoin? The extreme volatility. No?
Yeah.
So when volatility has been significantly lower, and at the same time the correlation with the Nasdaq became completely different, then a lot of investors started to look at it as, let's say, instead of a teenager asset, like a sort of grown-up asset that started to be something worth looking at. Because prior, a lot of people, and rightly so, thought, why own Bitcoin? I would rather own the Nasdaq. It's at least I have some earnings or some, let's say, idea of valuation to cling on to, while with the other thing I have no idea. And the only thing that I know, or that people tended to repeat over and over again about Bitcoin, was that Bitcoin was not a reserve of value in weak market times, because if the Federal Reserve started to hike rates and reduce liquidity, Bitcoin would fall alongside the Nasdaq, but harder. No? And I think that what has changed is the combination of these things: reduction of the confidence in the US dollar as an always strengthening asset, the divergence in policy between the Fed, the ECB, the Bank of Japan, and the Bank of England, and also the fact that Bitcoin as an asset has sort of separated itself from other crypto assets. No? So it's become an asset in itself.
Yeah.
And all those things, in my opinion, matter. No? So it's basically that we're starting to see this teenager grow up to become an asset that is worth looking at in a moment in which what many I've heard this numerous times when I talked about the gradual loss of confidence in the developed economies' currencies. A lot of people were saying that is an exaggeration, that is never going to happen, governments can print their way out of any problem, every time that developed economies increase money supply, that means more reserves for the private sector, and therefore everything is great. Stupidities, bullshit, no? But those were hugely repeated in a few years ago, and that has changed now.
Yeah, I mean, time and space changes things. I mean, I still get hate mail on what I didn't like about Bitcoin before the many times that it crashed, by the way.
You didn't believe. You didn't believe. Huh? Huh?
I believe in risk management. That's what I told Michael Saylor himself. He's like, dude, you got to believe in something. Well, I got to believe in what? Making you rich? I mean, hope.com style? No. It was very straightforward, and until proven otherwise, by the way, it's still a teenager, right?
Yeah.
Very well put. I mean, last I checked, Bitcoin's only 16 years old, maybe 16 and a half, something like that, because I think it was introduced in January of 2009 by Satoshi. If Satoshi is or he or she or this or that, we don't know what it is. I mean, but it's a teenager, very well put. And by definition, a teenager needs time and space to grow up and to lose the volatility. You cannot become a world reserve currency, world reserve asset in the case of gold, or both, until you grow up. You have to show that you can stand the test of time. And at least that's my definition of it, because as you know, I only allocate assets on the trending rates of change of volatility relative to the price and the volume, right? So we are actually seeing that. And I don't think it's as much a debate like the one point that you made there on separating Bitcoin versus crypto. I think most people in the institutional community have gotten at least comfortable being uncomfortable with that. But what is it like from here? I mean, you and I are well, actually, you gave me this joke. You say I'm from the future. I'm from Europe. Like, how would you just take that baton and go with it again? So what happens? Like, what would you expect? Provided that the fiats and their governments continue to age. These are old people, right? These are old, really old people. These are boomers mostly, and they're economists and their establishment. Like they're going to be put out to pasture if they haven't already. They have politically. Trump just doesn't get elected. You got to have something really fucked up to vote against. So that's already in motion. Can you maybe kind of mind the gap, as they'd say in London, between those two things? Between the teenager and the really old things that the market doesn't trust.
Yeah, what I think is going to continue to happen is that this gradual loss of confidence in developed economies' currencies, and which means the gradual loss of confidence in the solvency of the issuer of the currency, i.e. sovereign debt, is going to continue. We're already in the third year of losses in central banks, in their own asset base, in the large asset bases. So I think that all of that is likely to continue to drive people to stop repeating the mantras created in a very short period of time, between 2001 and 2024, of central banks can increase money supply forever and can increase their balance sheet forever and nothing happens. If the central bank is loss-making, nothing happens. Well, it does. So what I think is likely to happen is that the implosion of the monetary system as we have grown accustomed to using it is going to be gradual. That doesn't mean that the dollar or the yen or the euro are going to disappear. No, they're not. I think that Bitcoin and gold are going to work as alternatives that don't, let's say, eliminate the other currencies. Okay, because to start with, it's impossible. It's impossible to offset to substitute the US dollar with Bitcoin. It would be a depression in the global economy. No, it's a depression. It's impossible to substitute the US dollar in the global economy with gold. No, the same reason. Now it's even more impossible to substitute the US dollar in the world economy with the yuan or with a currency issued by the BRICS. No, I always say that the BRICS are like the Beatles with 4 Ringos. Makes no sense. No, yeah. People are not going to like this. Love Ringo, by the way. Nothing against, great drama, but obviously think about it. No, what are you going to have? You're really going to trust your savings and your salary in a currency issued by 4 serial devaluers? Makes no sense. No. So obviously, what we're seeing is a separation of the two worlds. No, and I think that we're going to grow accustomed to, despite a little bit lower inflation, but persistent inflation, we're going to grow accustomed to higher sovereign bonds yields than one would have imagined. So the period of forcing financial repression on savers and with that, offsetting the fiscal imbalances of governments is not that it's over as in next month or in the next 2 months, but it's gradually disappearing.
Yeah, that's and there's a lot of structural backdrop. Well, it is a policy actually. We just did a presentation on this on the, let's say, the new administration's integration of not only Bitcoin and related crypto, but also stablecoin and tying it to treasury demand because they need to have a lot of treasury demand. So, there's a new component to this where the teenager's running into like adulthood, and you're getting, I'm not saying that these current administration is the epitome of the ultimate of adulthood, but I'm saying that it is their policy, right?
Yeah.
Guys, show, we have a nice little cartoon there that we start with our SLR and stablecoins point. But stablecoins, it's on slide 143, but of our current macro themes deck. But the relationship's very clear. If you look at the next slide, slide 144 shows you Bitcoin against the dollar, or if you look at stablecoins themselves, slide 145, the total stablecoin market cap. I mean, that in a picture is more and more people trusting whatever they think that is.
Right? Of course.
Again, and trusting less of what they could have it in, which is in US dollars. So
absolutely.
Let's get to how you tie it to the treasury market next. But the trust point, like a currency, if you don't have trust, it doesn't even have to actually be true. I mean, if you trust it, you trust it. You do that.
Yeah, absolutely. Ludwig von Mises explained it perfectly. The only thing that gives the value to a currency is what is the next person that is going to use it.
Yes.
Find that that person may purchase. It has absolutely nothing to do with the gold reserves or with the wealth of the economy or with military power. It is everything. That's why they're called fiat currencies. Fiat is faith, is literally the manifestation of the credit solvency of a nation. Okay, so obviously it's no surprise that when people are all the time talking about the sustainability of government debt, and they're starting to realize that after stimulus packages, tax hikes, etc., the debt doesn't come down and deficits don't come down, as in France, as in Japan, as in the UK, etc., it's no surprise that the confidence in the currency is fading away. So that is absolutely perfectly logical. Now, there are two positions in the world right now, distinct, completely separate, of what to do from the perspective of governments and from the perspective of central banks relative to this challenge. The perspective of the US administration is, let's embrace stable coins, let's embrace crypto, let's bring all the capital that is going to be devoted to cryptocurrencies, and in some form that is going to generate a second derivative demand for US treasuries globally forever. So it's basically, in the mind of Scott Bessent, I would imagine, is basically replacing the balance sheet of the central banks of the world with the balance sheet of the crypto world.
Yeah.
So the Central Bank of China, the Central Bank of Poland, the Central Bank of India are not purchasing sovereign bonds anymore, or not at the same pace. And they're purchasing gold. We're going to offset that impact with the crypto balance sheet. That is one way of looking at it. Then you have the European way. Beautiful. What is the European Central Bank way? Let's impose it. Let's impose let's impose the digital euro. Okay. The European Central Bank is worried because they know that the euro has lost, it's now the third in terms of reserve assets in central banks, and knows that it's lost places in SWIFT payments. They panic. They say, okay, we need to impose the utilization of the euro, or we're going to lose the second world reserve currency, which is ludicrous in my opinion. Okay. So now, obviously, we can have a debate of which one of those two measures will be successful. You see what? You know what? I don't care. Both show that the issuer of the currency knows that the days of believing that issuing all and any amount of currency as you wished are over.
Yeah, that's this goes so far back, and thank you for that history lesson on what the word fiat obviously means. But like, think about a time when people didn't even know what history was. I mean, we can go back 2,000 years, and all people would believe is what it meant, right? That's how people came to believe in Jesus Christ. I mean, it's not that it's not that complicated to think through the behavioral realities of human beings. As time went on, I think by the 16th century...
This was money.
What's that?
This was money. A stick.
Right.
A stick. A stick was money. Huh? Traders all over Central Europe would exchange enormous sums of farming and different types of goods and services, and put little
notches.
Signs, in sticks. That was money. So the idea...
mean, you're talking like you're listening to a guy from Spain. I mean, in the 16th century, pieces of 8, or what you would know obviously as Spanish dollars or reals back then. I mean, that was actually considered the world's reserve currency to a degree.
Absolutely. No, so that's why, when they talk about money, they tend to talk about a very, very short period, so short period of time in the history of money that is statistically negligible.
Yeah.
They're basically talking about 2001 to 2024 as what money is, and it's not that, and it's never been that. No, the history of money is exceedingly simple. Empires are always created on the basis that they can issue a currency that is going to be accepted by the world just because they're an empire, and then suddenly the world stops using it and the empire crumbles. And that has happened through history all the time. Now, obviously, what you have right now is a different system. Is that what we are going back to? Is in fact the decentralization of money, which is, I mean, you don't need to go back many centuries, but you can go back to a period where there was no internet, and Friedrich von Hayek wrote a very nice and short book called Choice and Currency: How to Escape in order to escape inflation, which is the competition between independent currencies that would eliminate the incentive of central banks and governments to pass the imbalances of fiscal policy to consumers.
I mean, it's and if you can't tell, and behind him are some of the books that he wrote. He's written books on this topic, so please buy his books and get into the practitioner's education on what's actually happened. What is money? How does it fit in context? Where are we today? But this belief system, I think, really, let's take it back 2,000 years one more time, and we can go well beyond that. But really, I think it's a pretty long period of time that most people don't discuss. I mean, you go back to that period where history's not a thing. I either believe or don't believe, and it means something or it doesn't. To we spend the last at least 300 to 500 years explaining how governments are supposed to be trusted as the fiduciaries of this whole thing, and looking out like Powell says at the beginning of every single one of his bullshit speeches that everything we do is for the people. To the whole world believing the last 300 years of that is bullshit, right? So I don't trust this, so I'll go all the way back, and I can believe in whatever I damn well want. And the government is now saying, like Scott Besson's saying, enough people believe in Bitcoin and stablecoin that I can believe that I can tie my fate on the U.S. Treasury issuance curve to that belief. Is that fair?
It is absolutely fair. And if you think about it, maybe, obviously we don't know, but maybe the Roman Empire would have extended its life for a few decades further if the Roman emperors had started to understand that they could adopt some of the currencies that those tribes were using for their
Yes.
trade in order to keep the sesterce alive instead of destroying the purchasing power of the currency by putting a little bit more lead and a little bit more of not silver or not gold in the currency, no, in the coins. So it's ultimately, the idea is the Federal Reserve, the European Central Bank, the Bank of England, the Bank of Japan know that the problem is not the US debt that has been issued, it's not the UK debt that has been issued, it's not the French debt that has been issued. The problem is going to be all those committed but not financed liabilities that they have already, which in the case of France is about 400% of GDP. The case of the United States is about 100. So it basically means that it's not just that they are already spending way too much above what they collect as receipts. It's not just that it's already been proven, and therefore that's why the loss of faith is happening, that they increase taxes, debt doesn't go down. They increase the stimulus packages, growth doesn't become stronger. All those things that were sort of trying to maintain the faith, keep the faith in a Bon Jovi style, no, keep the faith. Huh? It's coming. It's coming. We're going to increase taxes. We're going to have fiscal consolidation. It's coming. We're going to implement a very aggressive stimulus package, and that is going to elevate growth, and therefore debt will come down relative to GDP. Well, none of that happened. People are not stupid. People are not amnesiac. They know when a government comes and says, as we just heard in France, that they're going to make the next phase really, really matter, that is not going to happen. So obviously what we have then is an environment in which you have those two options that were very interesting moment in money history. One is a government that is seeing the loss of the confidence in the US dollar and embracing the decentralized alternatives, and the other is one that, seeing the same thing, is trying to impose those through a digital currency that would imply that people have to use the currency or have no money at all.
This is a massive topic. A nice poll on Bon Jovi. That was 1992. That's the thing. When you get too, Daniel and I will be very critical of baby boom generation economists of the establishment. Okay, we have that in common. We're both Gen X, so let's just call us special. Okay, we're constantly getting screwed. Markets are always at some point about to crash when people say it's different this time and they're not, et cetera, et cetera. But we are probably, I'd say, Daniel, probably two of the later adopters of Bitcoin, certainly as a core asset allocation and having a place. And I'm personally okay with that. I don't know about you. Like, do you feel?
I don't have a problem. I don't have a problem. I didn't participate in the Apple IPO or in the Facebook IPO. I didn't. That doesn't mean that I didn't purchase those stocks when I found myself in a position where I was comfortable about their earnings and their growth. The idea that you need to somehow start your life with an asset, no, and be with it forever. Well, that may be fun, I don't know, for a fan club, but it's certainly not for the reason why you and I have always been good friends and understood what we were saying is because we're always thinking from the perspective of the most important thing in the economy, which is price, rate of change, and where that price is relative to volatility. And somebody else is more comfortable with a different part of the process. Absolutely fine. It's like surfing. You want to be you want to be on the shore. You want to be at the crest of the wave. I don't know. I prefer to navigate things in a way in which I am comfortable. And the way that I see it is, what would it have? This is a very interesting thing, because a lot of people say, oh, if you had bought Bitcoin when it was trading at $100, today you would be a multi-billionaire. No, no, my friend. No, you wouldn't. Because, because number one,
No,
if it goes
no,
from-
no, no, no. No, my friend.
First, because if it goes from 100 to 200, you sell. Let's be fairly honest. I sold my Apple shares at, at a price that is probably not very acceptable these days. You would have sold. Second, and I think that this is something that people don't look at, how people would have panicked when it went from 1,000 to 100, when it went from 10,000 to 2,000, when it went, you see, those huge, enormous corrections would have not made you stay on that asset. There may be somebody out there. There may be. I don't know. Congratulations. 99.9% of the population doesn't do that.
It's always a funny one, though. I mean, it's core to the permeable case. It's very similar to, if you would have bought that house in your neighborhood 100 years ago, you would have been, you're like, okay, so therefore I should go buy peak price right now in that neighborhood. No. Why don't I actually buy a house when interest rates go up, the demand goes down for for housing, et cetera. It is what it is. You and I are always going to be different. We're these Gen X people who didn't buy Bitcoin at 1 cent or whatever. But currently it has its place. And I do think that that's an interesting, maybe one of the last things that we can get through here is tying it to the one thing. Like, if this is indeed a belief system, right?
Yeah.
Because you do not believe in the government, you do not believe in the Federal Reserve, no matter what any of these people in the intelligentsia tell you, the biggest running joke that I can find that people don't even find to be quite funny are Fed jokes, right? I mean, it's like those things are a thing, right? So due to this disbelief and this belief system over here replacing it, I believe that the U.S. is going to, a lot of these people believe, okay, it's because of the deficit, it's because of the debt, it's because of using, but on the back door here, there's a backdoor fix for Bessent. Guys, go to slide 147 where, Tether and Circle in particular, if you combine the two, in terms of holders of U.S. treasuries, they've already eclipsed Saudi Arabia, South Korea, Germany. I mean, these are like, how do you think about that? Like, I mean, Scott Bessent has something in common with us as well.
Yeah,
right?
Absolutely.
He's
a market practitioner.
He's another Gen Xer, I think, or at least close to it. He'd be a very young boomer if he is. He looks great if he is a boomer. But he did our job.
Yeah.
He understands the flows. He understands how you tie it all together. It looks like if I look at bond yields should not be going down when the U.S. economy hits a quad 2. They should be going up, and now they're going down. Now, you can say, well, it's because they're going to replace Powell, blah, 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 blah. But this is a major new buyer of treasuries, and he's issuing it on the right part of the curve that they need it.
Absolutely. The greatest thing about Scott Bessent is that he's not only an incredible historian, because he knows economic history like very few other people do, and if you're interested, it's absolutely riveting to hear him in in conferences when he talks about his economic history. But he's a market participant. He's a practitioner. He's been investing for a very long period of time. So he understands that you need to be very, very focused on where there is going to be an increasing demand and where there is going to be a declining demand for the asset that you issue, i.e. treasuries. Okay, there is declining demand in the Central Bank of China, there is declining demand in the Central Bank of India. Therefore, as you have rightly pointed out in that slide, you are already offsetting the demand of entire nations, wealthy ones by the way, with this new, let's say, and thriving opportunity. I think that is much better than expecting the market to accept that through imposition, through the digital euro, you're just going to continue to be the second world reserve currency.
Yeah, Scott Bessent, by the way, is born in 1962, so he's older than both you and I, that would put him, as I thought, right at the tail end of being a boomer, because boomers are 1946 to 1964, thereabouts, right? What's next question on this? You know my colleague and partner Neil Howe, his fourth turning demography. It's not a thesis. Demography is one of the most irrefutable facts that we can find in economics, because it's just time and space, as Daniel and I have been talking about. Now, it's not teenagers. It's a super long-term cycle. But it isn't interesting that you have a very, very much somebody who's at the end of a generation and knocking on the door of ours, who is on the cusp of a major turn. I mean, if Scott Bessent isn't a fan of the Federal Reserve in its current construction, not even remotely close, right? He's no fanboy. He's a fan of history, to your point, and he is creative, and he's a capitalist. I can go on and on and on. So could this be the spot where it's like you and I like waiting for Godot or Godot, however you want to pronounce his name. Like we've been waiting for that moment for a long time. And we've had to deal with the Federal Reserve and the establishment not going away for our entire career. It's been one of the most annoying parts of my daily life.
Well, the day of reckoning has arrived.
You think so?
The day of reckoning. I think so. You don't? Why? Why? Because think about it. The day of reckoning has arrived because for many, many years you have heard these academics say, "Oh, we have these absolutely detailed models that can predict everything," and they predict nothing, obviously, because it's just an absolute joke that you can create an Excel spreadsheet that is going to predict human action. No, but the day of reckoning has arrived because not all governments and not all central banks can and are willing to embrace decentralization. It's pretty unique, to be fairly honest. For me, it's an absolute surprise. It's pretty unique to find a Secretary of State of the Treasury that embraces decentralization instead of trying to ban it. And obviously, as a libertarian, as an Austrian economist, I certainly find that is a much better alternative than what others are doing. But why do I say that the day of reckoning has arrived? Because the European Central Bank doesn't understand why the bond yields of Germany and France remain at the levels at which they are today, when they have cut rates by four times this year. The European Central Bank, not only the European Central Bank, but look at it from the perspective of all other central banks. In 2025 so far, we have had 64 rate cuts in the world. This is going to be the year of the highest number of rate cuts in modern economic history. So, and what are you seeing at the same time? The bond yields remain stubbornly elevated because it is the manifestation of the loss of solvency of the issuer of the currency. And that, think about this, inflation is like a de facto default. No? When a company issues a bond and defaults, what happens is that the bond yields soar, the price of the bond goes down. But if you think about it, inflation is the manifestation of the loss of the credit of the issuer. It means that the purchasing power of that IOU is diminishing constantly. No? Now, central banks want that purchasing power to go down by 2% per year. It's a quid pro quo by which one would expect higher growth, higher credit, and improvement in public finances. But global governments have found that they have surpassed the three limits that they have. Limit number one, the economic limit. More debt doesn't mean more growth, it actually means less. The fiscal limit, they increase taxes and the deficit doesn't go down, debt doesn't go down. Furthermore, interest expenses weigh more and more in the budget. And the third is the inflationary limit, is persistent inflation. So those three limits should have been warning signs for governments to be more prudent with their fiscal policy. But obviously, because Keynesianism is rampant all over the place, none of those governments is willing to accept that situation. So I say that the day of reckoning is coming, because it will manifest. We've already had two warning signs with Japan, two, in a short period of time, in a couple of years. We have had warning signs with France. We're going to see more and more warning signs that may lead to a financial implosion of sovereign debt. And a lot of people think, oh, that's going to be a collapse. No. When that happens, it does like this. When you see the implosion of sovereign debt, it's basically the risk is stagflation that you mentioned earlier, rightly.
Now that's an excellent summary. So if we take just to put a big macro bow on that for people that like narratives, you have 3 debt thresholds have been broken. The future of decentralization is here, and he thinks that this is the day of reckoning. Interestingly, the day of reckoning is
arriving, at least.
The day of reckoning, which can be many days. In both the Christian and the Islamic faith is basically the last judgment. So the last judgment on all this bullshit is that it's bullshit. I mean, it doesn't matter what your religion is. I think it's you've connected as only you can do, like a lot of dots for me on this front, and it doesn't. When you say things like the day of reckoning or its time has come, people do actually immediately say, well, that must mean chaos, crashes, and the end of everything. I mean, actually, no. If you look back 6 months, it means like an epic breakout in gold and a resurgence in Bitcoin and a lot of other things that you can make money on.
Oh no, absolutely. Don't believe in it as something that is going to lead all risky assets down at all. Because the finance world is a world of relatives, and obviously we need to understand that the loss of confidence in sovereign debt issuers doesn't mean that they disappear. It means that their ability to conduct fiscal policy and their ability to conduct the measures that have been the norm in a very short period of time, which is the last 20 years, is coming to an end. And that is not a bad thing for people, actually, if you think about it. What is a bad thing for people is if we had gone down the route of MMT, of the modern monetary theory, which is modern and is not a theory, is what is what everybody has done all the time. No, it's to destroy the currency. No, so that would have been the bad thing. The good thing is that markets are telling is that you have a government in the United States that admits that the problem is not a problem of revenues, it's a problem of expenditure. Obviously, you can debate whether the actions are as good as you would expect or not. But things are starting to change from what we were getting used to a couple of years ago in particular, which was the following. Post-COVID, we were being told the narrative, the absolute train crash narrative, that we had found the absolute marvel, which is that governments and central banks need to be the issuer of first resort and the financier of first resort. That has led to inflation, that has led to higher debt, that has led to worsening of the polarization in political debates. Therefore, all those things are manifesting at the same time. And you mentioned prior demographics, because this is the other one, the elephant in the room that very, very few economists talk about, the hugely important problem of demographics. That is why we mentioned, I think in our last conversation, that the fourth turning, of course, is already here, no?
Yeah, that would be an understatement. So, thank you for for having this conversation. We kind of know what we're going to talk about, but we really don't know how the conversation is going to drive itself to what points. But I mean, really to get us to the day of reckoning. Which again, if the last judgment is that the Fed's full of shit, fiat currencies aren't trusted, if that is indeed the last judgment, that is the original, the OG definition of the day of reckoning, then I'll be satisfied with that. I'd have to agree with that. I'd say that is an objective day of reckoning. That is an objective last judgment. So thanks, Daniel. I appreciate that.
Thank you very much, Keith. I enjoyed it.
How good is he? Like, I mean, there aren't many brains in the world that can put all that together. And again, I think it's super important to listen to people who actually do things, right? That do the job, that have risk managed markets. And again, Scott Besson is in that group. We're not having a fanboy session on that. We're trying to connect some dots on our bullishness on things like Bitcoin in particular, how it flows to stablecoin and treasuries, et cetera. But again, think about Lacalle's points of view, think about his perspectives, because they are not a traditional economist perspective, they're not a traditional old wall strategist perspective, they are his perspective. And that is a very valuable thing.